The portfolio in the first quarter really gave back a lot of performance on the industrial manufacturing side and on the energy side as well. With the industrials, I think there was a bit of a hangover from last year's success. You had a lot of momentum going into the end of the year. A lot of the end markets were very, very strong. As the feeling that rates would move up crept into the market, made people nervous. A fair amount of these companies have some substantial debt. Throw that on top of the growth fears that come after interest rate fears, and you get a pullback. And again, we're in a part of the market where liquidity isn't great, so it doesn't take a lot to get things rolling backward. We think that'll reverse. We think especially if GDP continues to perform better than expected, and I wouldn't be surprised if these were names that really led the charge next quarter. We do what we always do. We try to take advantage of that volatility. Admittedly, we've had two very, very good years in a row, so it is more difficult, I think, to make money now. So you've really got to find those things that either are going to surprise a lot of people with their ability to earn money after going through a difficult time, right, a tough turnaround, or really grow better than expectations are. But it'll definitely be from a smaller amount of names, as a lot of the expectations are priced into a lot of stocks now. Technology, not surprisingly, worked very well in the quarter. Continued, I think, on the back of the large cap names that really have been driving the entire market. We continue to think that there will be a tremendous amount of volume in semis and all sorts of devices, and pricing remains pretty strong. There is a concern that, again, we're at the end of a cycle, but we think there's clearly more to go here. Some other things that we think will continue to work are going to be some infrastructure plays. We think aerospace, defense will continue to work pretty well. And many of the things that were weak in the first quarter, especially relating to energy, we think should have a strong comeback as well. The housing sector continues to be one, I think, that frustrates a lot of people in the market. It is one where you just don't have enough product. Like many other industries that go through massive, massive change or consolidation, housing has taken incredibly long to get back and get back normalized. So the stocks are very, very reasonable as far as pricing goes. And the outlook, especially with strong employment, should be pretty good. You get into this argument with interest rates, whether or not you're going to have a cycle that stops dead, and we don't think it's going to happen. So we've actually added to some housing names. Financials have been a place that we continue to look for more names in, especially in places down south and in some of the population centers that are growing the fastest, and we've had some good fortune there. And in retail, always looking for those specialty retailers that could grab their glory again, if you will, right? Get margins back to where they used to be and really produce some earnings in a relatively short amount of time. The mega caps spending is tremendous. Amazon, Google, Facebook, Tencent, Alibaba, massive storage, and that's really helped many of our component companies. There's a shortage globally of capacitors. Memory pricing has been better than expected for a while now. So they're really doing what we had hoped it would do, which is keep a really long sustained rally going and really letting us not only benefit from better earnings, but also some pretty good consolidation in the small cap area as well.